We're tackling something really crucial for, anyone looking to make consistent gains in short-term trading.
Absolutely. How you handle your winning positions, it makes a huge difference.
Exactly. We're going to look at two main ways: scaling in and easing out.
Scaling in, easing out. Two very different philosophies, really.
And we'll explain why we at Accumulation Pro lean towards one of these as maybe the more, let's say, robust approach, especially for navigating those market swings reliably.
Right. For sustained success, that consistency is key.
Okay, so when a trade goes green, you've got these two main paths people talk about. Scaling in,
which is basically adding more money to a trade that's already working. You buy some, price goes up, you buy more.
And the other path is easing out.
Or scaling out, same thing. That's where you sell parts of your position as the price climbs.
Locking in profits bit by bit.
Exactly. You secure some gains, but let the rest potentially run further.
Now, both have their advocates, definitely. But, here at Accumulation Pro, we do have a strong view.
We really feel easing out offers a more, strategic and reliable path through those choppy short-term waters.
To really get why, maybe let's first explore the logic behind scaling in. Why do people do it?
Well, the main appeal, especially in a strong uptrend, it often comes down to riding momentum.
You see the price moving up strongly and you think, okay, this has legs.
Right. And that strong upward move might signal significant buying interest, maybe even, institutional buying, the so-called smart money accumulation.
Big players getting involved.
Exactly. Large firms actively buying can suggest a really solid underlying trend. So the idea is, by adding more, you align yourself with that buying pressure.
And potentially boost your gains if more buyers, maybe retail traders, jump on board.
Precisely. They see the price rising, fear of missing out kicks in, and they pile in, pushing it higher. That's the hope anyway.
There's also this idea of averaging up, isn't there?
Which is different from averaging down, buying more of a loser, which is generally quite risky.
Right.
Averaging up means buying more as the price increases. It ties into that saying the trend is your friend.
If it's going up, it's likely to keep going up.
That's the theory. Especially if your technicals look good, moving averages aligned, a breakout, strong volume, that kind of thing. Scaling in can feel like the logical next step to maximize returns.
Okay, that makes sense. But, and this is a big but.
It is. It's definitely not a guaranteed win, and scaling in carries some pretty significant risks.
What are some of the main downsides we should be thinking about?
Well, first off, you're putting more and more capital into just one single trade. Concentration risk.
Less diversification.
Exactly, which limits your ability to spread risk. Plus, psychologically, you can get very attached to that one position as it gets bigger.
More emotionally invested.
Yeah, and the fear of losing those paper profits can really grow, potentially clouding your judgment, leading to maybe less rational decisions.
And if that trend does reverse, a bigger position means a bigger hit.
Absolutely. It magnifies the potential loss. If that uptrend suddenly fails, a larger position translates to a much larger drawdown, which can be tough, especially for traders who haven't developed that institutional level nerve, that smart money resilience.
There's also the opportunity cost to consider.
Good point. All that capital tied up in one potentially long trade means you might miss other good setups appearing elsewhere in the market.
And volatility. A bigger position feels more volatile, doesn't it?
It certainly does. A sharp, sudden pullback can erase a significant chunk of gains much faster with a larger position size. And maybe the most critical risk.
Go on.
Remember those institutional players, the smart money? They're not just buying. They also need to sell eventually.
Right, to realize their profit.
Exactly. And they often anticipate that wave of retail enthusiasm. They might actually start selling their shares, distributing them, precisely when individual traders are most eagerly scaling in at those higher prices.
Setting the stage for reversal, selling into strength.
Precisely. And this is where our thinking at Accumulation Pro really emphasizes a more, let's say, risk-aware approach, rather than just chasing performance.
Which leads us nicely into easing out. Why do you see this as the generally smarter strategy?
Well, unlike scaling in, which increases exposure, easing out is fundamentally about securing profits. That's the primary goal.
Taking money off the table.
Yes. As the price moves your way, you systematically sell portions. You lock in realized gains, reducing the risk of giving those unrealized profits back if the market turns against you.
Key insight there. easing out prioritizes securing gains.
Definitely. And beyond the financial aspect, it's huge for emotional management.
Oh, so.
Holding a very large volatile position is stressful. Every tick up or down can cause anxiety. By taking profits incrementally,
You reduce that pressure.
you reduce the pressure significantly, allows for clearer thinking, more rational decision-making, which is vital in swing trading's faster pace.
And it frees up capital too, right?
Absolutely. As you sell pieces, that cash becomes available. You can redeploy it into new opportunities that might be emerging.
So it allows for more flexibility and diversification.
Exactly. Instead of being heavily concentrated in one name, even a winning one, you can spread your capital, especially in a broadly positive market where maybe lots of stocks are moving up.
You can participate in more potential winners.
Right. You can participate across a wider range of strong setups. It aligns with benefiting from broad market participation rather than just betting it all on one horse.
That actually touches on a core principle at Accumulation Pro, doesn't it? Diversification over concentration.
It really does.
Right.
We generally advise against aggressively piling into just one stock. Instead, especially if the broader market like the S&P 500 is trending up, spread that capital across several promising assets.
Like the rising tide lifting many boats idea.
Exactly. It's often wiser to have a stake in several strong contenders. It mitigates the risk if one specific stock falters unexpectedly.
Okay, so easing out makes sense conceptually, but how do you do it effectively? Is it just arbitrary selling?
No, not at all. At Accumulation Pro, our approach is data-driven. We don't believe in random selling. Our algorithmic strategies often use oscillator divergences to time the easing out process systematically.
Oscillator divergences. Can you break that down a bit?
Sure. So a divergence happens when the price of an asset is doing one thing, but a technical indicator like the RSI, the relative strength index, is doing something different. They're diverging, moving apart.
And that tells you something.
It can be a really valuable early warning sign that the momentum behind the current price move might be weakening. A potential change could be coming.
Like the engine sputtering even if the car's still rolling uphill.
That's a great analogy, exactly. It suggests the upward climb might not be sustainable. We look for two specific types of bearish divergences when considering easing out of a long position.
Okay, what are they?
The first is a bearish regular divergence. This happens in an uptrend. The price makes a new higher high.
So still going up.
Right. But crucially, the oscillator makes a lower high compared to its previous peak. Price up, momentum indicator down.
Suggesting the buying power is fading.
Precisely. It hints the uptrend might be losing steam, potential reversal coming.
And the second type.
That's a bearish hidden divergence. This one's a bit different. Here, the price makes a lower high.
So it didn't quite reach the previous peak.
Correct. But the oscillator makes a higher high. It seems counterintuitive maybe, but this pattern also suggests underlying weakness in the upward momentum. The trends might be tiring out.
Interesting. So how does Accumulation Pro use these signals to ease out? What's the strategy?
It's designed to be systematic. When our algorithms detect a bearish hidden divergence, the typical action is to ease out by selling a percentage of the position equal to the current percentage gain.
Okay, so if the trade is up, say 15%, you sell 15% of the shares you hold.
Exactly. You lock in some profit proportionally to how much you're up, but you keep a significant chunk of the position active to capture potential further upside.
Makes sense. What about the other type, the regular divergence?
When a bearish regular divergence occurs, which, remember, often signals a more significant weakening and higher reversal probability, the easing out becomes more aggressive.
How much more aggressive?
Typically, we'd sell twice the percentage of the gain on the remaining position.
Right, so if you were up 20% overall, maybe you already sold some on a hidden divergence and now this regular one pops up, you'd sell 40% of what's left.
Correct. That more decisive action reflects the heightened risk that the regular divergence signals.
And this isn't necessarily a one-shot deal, right? This can repeat.
Oh yeah, absolutely. The process is iterative. As the price potentially continues higher, the algorithms stay alert for new divergences, hidden or regular, and we continue easing out based on those rules.
So you're participating in the trend, but constantly reducing risk and banking profits along the way.
That's the goal. Participate while strong, protect when weakening. The rationale connects back to market psychology and smart money behavior.
How so?
Well, those bearish regular divergences often appear in overbought conditions. That's frequently when retail excitement peaks, and institutions might see it as a good time to start selling, taking profit.
They're creating that selling pressure.
Exactly. And by combining these divergence signals with analysis of price action and volume, our algorithms aim for more precise exit timing.
You mentioned algorithms. This sounds like something that requires automation or at least very disciplined execution.
Discipline is key, whether automated or manual. Automation helps remove the emotion, of course. And one practical point for anyone implementing this.
Yes.
Low commissions are important. If you're making multiple partial sales to ease out, transaction costs with some brokers could add up.
Good point. So choosing a low or zero commission broker makes this kind of strategy more viable.
Definitely more cost-effective, yes.
Ultimately, this whole discussion, scaling in versus easing out, it seems to boil down to understanding market dynamics and managing risk, doesn't it?
It really does. You have to acknowledge how markets behave. During strong uptrends, yes, retail excitement, FOMO, greed, it can drive prices higher, create momentum.
But that same enthusiasm creates the opportunity for the smart money.
Exactly. The more experienced players often use that strength, that buying enthusiasm, as liquidity to sell their shares at favorable prices, distributing their holdings.
So easing out aligns better with that professional approach.
We believe so. By taking profits gradually as the trend matures and shows signs of weakness, like divergences, you're essentially mimicking that sophisticated tactic of selling into strength.
It helps manage that fear of losing the profits you've made.
Definitely. And it provides a structured way to deal with market uncertainty and volatility. Using objective signals like divergences provides a discipline.
It helps you capture a good chunk of the move while proactively cutting risk as things potentially turn.
That's the core idea. Balance capturing gains with prudent risk mitigation.
Okay, so wrapping up this deep dive then. We've looked at scaling in, adding to winners, and easing out, taking partial profits.
And we highlighted the risks of scaling and concentration, emotional stress, vulnerability to reversals.
And made the case for easing out as, well, the AccumulationPro preferred approach, focusing on securing profits, reducing stress, freeing up capital.
Aligning with smart money tactics and market psychology, using tools like divergences for systematic execution.
Right. It's presented as a more strategic way to handle winning swing trades.
We certainly see it that way.
Now, if you listening are interested in exploring more advanced strategies, tools designed to really navigate these dynamics,
Then visiting AccumulationPro.com is the next step.
yeah, you can discover the kind of cutting-edge trading algorithms we've been talking about. Algorithms designed to follow those smart money principles, prioritizing risk management.
All aimed at achieving sustained success in the markets. That's the focus.
Because ultimately, successful trading isn't just about picking the right stock, is it?
Not at all. It's about disciplined execution of a sound strategy, one that respects market realities and has risk management built into its core.
That really is the foundation for long-term growth in this challenging but potentially rewarding world of trading.